Okay, I think we can now start. We have about 63 participants who are connected. Dear Excellencies, distinguished participants and colleagues joining us from across Africa and around the world, good afternoon and welcome. On behalf of UNCTAD, I warmly welcome you to this Africa launch of the World Investment Report 2026. My name is Judith Ameso. I work with UNCTAD's Regional Office for Africa, and I'll be moderating today's event. Before we start, I would like to request you all to kindly ensure that your microphones remain muted. And we also invite you to use the chat box for any questions to our speakers. We will have an opportunity to address as many as time permits later on in the course of the event. So this annual report, UNCTAD's World Investment Report, is the flagship publication of international investment trends and policies. It provides governments, investment promotion agencies, development partners, researchers, and the private sector with authoritative analysis on global and regional FDI trends and their implications for sustainable development. This year's report explores international investment in a turbulent era. And we'll hear more about this from the presentation that will be made a bit later on in the event. But from the report, we will also see that FDI is recovering or has been recovering during the year 2025, but this recovery remains uneven and increasingly concentrated in a relatively small number of economies and strategic sectors. For Africa, the challenge is not only attracting investment, but ensuring that investment contributes to productive capacity, industrialization, technology transfer, job creation, as well as sustainable development. So today's discussion provides an opportunity to examine what the latest trends and the latest evidence means for African policymakers, investors, development partners, and how the continent can position itself to benefit from evolving global patterns. We are delighted that so many of you participants have joined us today from different groups, from governments, from regional organizations, investment promotion agencies, development finance institutions. We also have some academia, civil society, and the private sector. We thank you very much for being here. And to start us off, it is my pleasure to invite Ms. Nan Collins, who is the Director of UNCTAD's Division on Investment and Enterprise, to give her opening remarks. Nan, over to you.
Thank you, Judith. Excellencies, distinguished delegates, it is a great pleasure to welcome you to this African regional launch of the World Investment Report 2026. Allow me first to thank our distinguished keynote speaker, His Excellency Dr. Ahmed Rustem, Minister of Planning and Economic Development of Egypt, and our other panelists who will bring expertise from different regions of Africa joining us today. And this discussion comes at an important moment. The headline message is clear from our report. FDI is recovering, but the investment landscape is becoming more strategic, more selective, and more concentrated. The report shows that global FDI increased by 6% to 1.6 trillion after 2 years of decline. This is an encouraging sign. Yet the recovery remains uneven. Investment flows to developed economies rose by 11%, while developing economies recorded growth of only 2%. Investment is also becoming more concentrated across countries, sectors, and large projects. The central message of this year's report is important. The question is no longer how much investment goes across borders, but where it goes, what it builds, and who benefits. That means investing in new productive assets, stronger domestic firms, better jobs, supplier linkages, technology transfer, and access to regional and global value chains. So what does this report tell us about investment in Africa specifically? Africa attracted approximately US $70 billion in FDI in 2025. While this represents a decline from the exceptional high level recorded in 2024, this number still remains the third highest level of investment ever recorded for the continent, and also 1/3 above Africa's long-term average. So beyond this overall level of investment, its composition also tells us a positive story. As you will see later in the presentation, the numbers of projects increased. This suggests that investor interest in Africa remains strong, and in many ways has become broader. Instead of relying on a handful of mega projects, Africa is attracting a larger number of investment projects across different countries and sectors. This is an encouraging signal because greenfield investment often provides a clear indication of investors' long-term confidence and contributes directly to the expansion of productive capacity. Around the world, investment is fast growing in strategic sectors such as digital infra, critical minerals, advanced manufacturing, and technologies supporting the energy and digital transition. Greenfield investment has increased more than fivefold from 109 billion to 576 billion. However, investment in these sectors remains highly concentrated in a small number of economies. Low and lower middle income economies receive only about 10% of the investment in strategic sectors. And this is a risk. The industries that will drive the next wave of growth are expanding fast, but access to them is narrow. The new investment race is concentrated among a small number of advanced economies. But this does not mean developing countries have no opportunities. Some do have entry points through natural resources, green industrial value chains, digital markets, regional manufacturing platforms, or specific capabilities. But these opportunities are not automatic. They require targeted policies, stronger institutions, and realistic strategies. Africa possesses many of these assets needed for this new investment landscape. The continent has abundant renewable energy resources, significant reserve of critical minerals, a rapidly growing digital economy, expanding consumer markets, and one of the world's youngest populations. These are major comparative advantages. We're also seeing new patterns of investment emerging. Alongside the traditional investors, companies from the Gulf region and other Asian economies are becoming increasingly important partners, investing in energy, logistics, infrastructure, manufacturing, and real estate across the continent. This development creates significant opportunities, but they also raise an important question. How can Africa ensure that these investments become engines of industrialization rather than isolated investment projects? The real development gains come when investment creates domestic value through processing, supplier development, technology transfer, skills upgrading, and stronger regional value chains. Africa needs investment that creates better jobs, strengthens local enterprises, and supports economic diversification. This requires investment policies that connect foreign investors with domestic firms, encourage local value addition, and foster innovation ecosystem. This requires reliable infrastructure, affordable energy, skilled workers, efficient investment facilitation, stronger domestic suppliers, and transparent regulatory frameworks. Regional integration will also play a decisive role. Through the African Continental Free Trade Area, African countries have an opportunity to create larger integrated markets that make investment projects more competitive and attractive. For many investors, the African market is no longer defined by national borders, but increasingly by regional opportunities. At UN Trade and Development, we remain committed to supporting African countries in this journey. Through the World Investment Report, our investment policy reviews, technical assistance, investment facilitation program, and capacity building for investment promotion agencies, we work with governments to identify realistic investment opportunities and strengthen the conditions to attract quality investment. Our objective is to help countries translate investment into sustainable development outcomes. Distinguished delegates, global investment is changing. Competition for investment is intensifying. Africa has opportunity to position itself strategically within the industries which will define future growth. The challenge now is to transform investor interest into productive investment and industrial development, and into better lives for the people of Africa. I hope today's discussion will contribute to that shared objective. And lastly, I would like to invite you to continue this dialogue and foster more investment partnership at our 9th World Investment Forum, to be held in Doha, Qatar from 25th to 27th October. Thank you.
Thank you very much, Nan, for those insightful remarks and sharing some of the headline and key messages from the report. I will have a little bit of time to discuss them later on in the event. It is now my honor to invite our distinguished keynote speaker, His Excellency Dr. Ahmed Rostom, the Minister of Planning and Economic Development of the Arab Republic of Egypt, to officially open today's Africa launch of the World Investment Report 2026. Excellency, the floor is yours.
Well, thank you so much, Ms. Judith, Ms. Nan, Dr. Ashraf, and colleagues at the UNCTAD and colleagues online with us. A pleasure to be here, distinguished colleagues, Excellencies, ladies and gentlemen. It's a great pleasure to join you today for the Africa launch of the UNCTAD World Investment Report 2026. Again, yet another excellent outcome and output of UNCTAD's engagement with Africa, and particularly with Egypt as well, that I commend and welcome. Allow me to commend the UNCTAD for producing yet another timely and insightful report at a defining moment for the global economy. As we heard from Ms. Nan, I think the report reminds us that although the global FDI has recovered to almost $1.6 trillion in 2025, the environment in which the investment decisions are made has fundamentally changed. The geopolitical tensions, the trade policy uncertainty, rapid technological change and advancement, as well as the growing economic security considerations are reshaping global investment patterns, as well as the global economy. Capital today is becoming more selective, more strategic, and increasingly concentrated. The key question before us is therefore not whether the investment landscape is changing, it's how Africa can position itself successfully within the new environment and transform these global shifts into sustainable, inclusive, and resilient growth. Well, the World Investment Report demonstrates that international investment is undergoing a profound structural transformation. For decades, investment decisions were driven primarily by production costs and market access. Today, they are increasingly shaped by technological leadership, resilient supply chains, industrial capabilities, and economic security. Investment is becoming concentrated in strategic sectors such as clean energy, infrastructure, advanced manufacturing, digital technology, and critical minerals. Yet low and lower middle income economies continue to attract only a limited share of investments in these sectors. This represents not only a challenge, but also a significant opportunity. And the message is clear. Success today is no longer about attracting more investment. It's about attracting better investment. Investment that builds productive capacity, transfers technology, creates quality jobs, promotes innovation, and strengthens long-term competitiveness. In this changing landscape, Africa is exceptionally well positioned. Despite global uncertainty, the continent attracted approximately $70 billion in FDI investment in 2025, demonstrating continued investor confidence. Africa possesses many of the assets that will shape the next generation global investment. Its abundant critical minerals, its enormous renewable energy potential, its young and dynamic workforce, and its rapidly expanding consumer market. Even more importantly, the African continent, FTA, is creating a foundation for a truly integrated continued market. Continued implementation of the AfCFTA together with stronger regional connectivity and trade facilitation will enable Africa to build regional value chains and larger production networks capable of attracting higher quality investments. As global companies diversify supply chains, Africa has a historic opportunity to position itself not only as a supplier of strategic resources, but also as a competitive manufacturing, logistics, and services hub connected to regional and global value chains. Realizing the opportunity, however, requires deliberate policy action. The World Investment Report shows that governments worldwide are increasingly adopting targeted industrial policies and investment facilitation reforms to compete for strategic investment. From Egypt's experience, 3 priorities stand out. First, strengthening the investment climate through transparent regulation, effective institutions, and streamlined administrative process. Initiatives including streamlining of licensing and tax payments through digital means, simplifying business procedures, and facilitating trade can strengthen investor confidence, and we're committed to this and we'll continue working on it. Second, aligning investment policy with industrial transformation, which is critical for attracting FDI, in addition to enhancing the role of trade corridors and logistic corridors, including the Suez Canal Economic Zone. Third, sustaining long-term investor confidence through stable policies, effective institutions, and sound legal frameworks. Together, these pillars demonstrate that competitiveness today depends not only on incentives, but on building a comprehensive investment ecosystem that connect policy, institutions, infrastructure, skills, and productive capacities. Excellencies, ladies and gentlemen, allow me to conclude. The periods of global transformation inevitably create uncertainty, but they also create opportunities. Africa possesses enormous untapped potential to become one of the world's leading destinations for strategic investments. Our challenge is not simply to attract more capital. It's to ensure that investment accelerates industrialization, strengthens regional value chains, fosters innovation, creates quality employment, and delivers sustainable and inclusive development. Egypt's experience demonstrates that sustained reforms, effective institutions, and a clear long-term vision can help create the condition for investment to strive. While every country's path will differ, our objective is shared. Ultimately, Africa's success will not be measured by the volume of investment it attracts. It will be measured by its ability to transform investments into stronger productive capacity, resilient economies, quality jobs, and shared prosperity for African people. I'd like to thank you again so much, and I wish you all a productive, insightful discussion. Thank you.
Thank you very much, Your Excellency, for those inspiring remarks, for sharing Egypt's experience, and more importantly, for reaffirming the importance of better and quality investment in advancing Africa's development priorities. We now move to the central part of today's program. I'd like to invite Mr. Ashraf Abdellal, who is a senior economist at UNCTAD in the Investment Trends and Issues branch, who's also one of the authors of the report, to present the key findings of the report. Ashraf, the floor is yours. You think you can do this in 20 minutes?
Yes, I will try to do my best.
Okay, thank you. Over to you.
Good afternoon and good morning, all excellencies, heads of investment promotion agencies, distinguished ambassadors, colleagues, ladies and gentlemen. So first of all, let me just extend my sincere appreciation to His Excellency Dr. Ahmed Rostom for accepting our invitations to deliver the keynote address at this time. I know that he is in New York and it's early in the morning and he's heading back to Cairo. So really, we really appreciate that and thank you so much. And have a safe trip back. It's a great pleasure to welcome you today and to present the key findings of the World Investment Report 2026. So with a special focus on Africa. So this year's report carries a particularly important message. So although global investment has started to recover, the investment landscape is changing fundamentally. So investment is becoming more selective, more concentrated, and more competitive, as Nance mentioned. So today's my presentations will have only 4 parts. The first one, which is basically we see what happened globally for the international investments. Then what happened in Africa. We're gonna zoom in on Africa, and then most importantly, why did it happen? And finally, we're gonna have the thematic chapters, which is basically during the thematic chapters, international investment and in a turbulent era, we will be able to answer the questions: what can policymakers do to attract more productive investment in today's increasingly complex global environment? And by this, we will set the stage for our panel discussions with the distinguished panel members. So let me just start with the first slide. So at first glance, the global investment picture looks encouraging. So global foreign direct investment increased by 6% in 2025, reaching $1.6 trillion. But this recovery follows several years marked by successive global shocks, including the COVID-19, geopolitical tensions, high inflation, and tighter financial conditions. And therefore, at first sight, these results appear very positive. However, as economists, we always look behind the headline numbers. Yes, global FDI increased by 6%, but this growth has far from broad-based. Most of the increase was concentrated in a limited number of economies and sectors. At the same time, if you look for the cross-border merger and acquisitions, which is among the multinational enterprises, they remained below their long-term average, showing that the companies to be cautious about large international acquisitions. So similarly, if we are looking for the international project finance, it increased by only 3% and remained around 25% below its 2021 peak, and suggesting that the investment in a major infrastructure projects has not yet fully recovered. And if we can look to the greenfield projects, it's already increased in terms of value. However, most of the increase, it was supported by investment in digital economy. So the second important message is that the global recovery was highly uneven. So developed economies recorded an 11% increase in FDI inflows, reaching nearly 1 trillion, accounting for almost 60% of global FDI. By contrast, developing economies grow by only 2%, with inflow reaching around $700 billion. So the regional pictures was equally diverse here. So Africa, they already decreased 26%, recorded 70 billion. Latin America remained broadly stable, while developing Asia continued to attract almost 600 billion, which is remaining the largest destinations for FDI among developing regions. So what explains these differences? So we have several structural factors are shaping today's investment decisions. So we have higher interest rate, we have continued geopolitical tensions, we have growing industrial policy competition, and increasing government interventions in some strategic sectors. So as investors become more cautious, they increasingly favor economies that already offer strong infrastructure, stable institutions, large domestic markets, skilled labor, and well-established industrial ecosystems. In other words, so countries are no longer competing simply on labor cost or market size. There are competitions on the overall quality of their investment environment, and this is for sure very important for African policymakers. So here, the slide highlights another important structural shift in global investment. So investment is becoming increasingly concentrated in capital and technology-intensive sectors. So we see strong growth in digital economy, where investment increased by 47%, reflecting the rapid expansions of the AI infrastructure and data centers. So an investment in infrastructure and semiconductor also increased by 11%, while investment in extractive industry grew by 8%, driven by rising demand for critical minerals needed for the energy transitions. By contrast, investment in global value chain intensive manufacturing declined by 13%, showing that some traditional manufacturing industries continue to face pressures from geopolitical trade uncertainty and changing trade patterns. So if we're gonna look to what this means for sustainable development, so there is an encouraging progress for investment in SDGs goals. So we can see that there is an increase in the infrastructure. However, most of this increase is already supported by the increase in digital infrastructure. So it has been increased by 61%, and investment in agro-food business also increased, but it's increased from lower base. So the two sectors are fundamental for long-term development. However, the recovery still remain uneven. So investment in renewable energy declined by 5%, water and sanitation also declined by 5%, while health and education fell by 7%. So as a result, although some SDG sectors are recovering, and modest, let me say that this is modest recovering and supported by increasing investment in digital economy. But overall, SDG investment in developing economies remained broadly unchanged. In value, declined by 1%, while in number of projects, it's fell by 6%. So here the policy message is clear. So attracting investment is no longer enough. So we need to attract investment into sectors that matter most for sustainable development, industrial transformations, and long-term resilience. So the challenge is not only to attract more investment, but to attract the right investment. And for Africa, I think this presents both challenge and also opportunity, because the countries that can position themselves in fast-growing sectors such as digital infrastructure, clean energy, critical minerals, and advanced manufacturing will be best placed to attract the next generation of international investment. And we saw this year when some of the African countries, they already succeeded to attract a lot of investment, like Mozambique, like Guinea, and most of the investment it was in critical minerals and minings. However, the good news that most of those countries, they are LDCs. This has already impacted the increase of investment to African LDCs, the 32 countries, to about $33 billion. It's increased by 21%. However, again, we need to look behind those numbers and figures, because the investment is very concentrated. So this is gonna move me to the next part of my presentation, which is to turn to focus on Africa. So if you only look at the headline numbers, you might conclude that Africa had a disappointing year. So the investment has already decreased from 94 to 70 billion, which is it decreased by 26%. But that would be the wrong conclusion. So the data tell a much more encouraging story. So the apparent decline in investment during 2020-25 is largely explained by the absence of few exceptional mega projects recorded in 2024, basically, namely the Ras Al Hikma in Egypt. Once we adjust for those one-off transactions, Africa actually recorded one of its strongest investment performance in recent decades.
It's 14 hours.
This distinction is extremely important for policymakers, because good policy should always respond to the underlying trend, not to statistical distortion. If we're gonna look for the sub-regions, North Africa remained the largest recipient of FDI, accounting for just over half of the total inflows, largely for sure driven by Egypt. West Africa recorded one of the strongest growth rates, supported by Guinea and Nigeria. East Africa continue attracting investment into infrastructure, renewable energy. Southern Africa showed mixed performance, while Central Africa remained supported by mining investments. So this diversity reminds us that there is no single African investment model. Each country is building its own competitive advantage. Some compete through renewable energy, others through mining, others through manufacturing, logistics, and that diversity is one of Africans' strengths. So if we're gonna look for the top 10 FDI recipients country, for sure, we can see that Egypt already received like more than one fifth of the FDI, and Egypt provide another excellent illustrations here, because there are a lot of projects in international IPF, International Project Finance. Maybe we can highlight one of them. It's the $26 billion Alam Room development, supported by Egyptians and Qatari investors, which is one of the continent's largest integrated projects. So the first portion of this investment is already dispersed in last year, and has been mentioned in the balance of payment of Egypt. But Egypt's story doesn't stop there. So we can see that some Indian companies, they already announced $6 billion green hydrogen. Also, French joined Egypt through the Ras Shukair green hydrogen facility, and Saudi Arabia's Al Well invested in the Hurghada wind projects. Also, if you're gonna look for Guinea, it's for the first time to be the second country in Africa to receive FDI, and for sure this is supported by investment in mining. Mozambique as well, Nigeria, and Ethiopia, Uganda, Morocco, they already received about $3.3 billion in FDI, and most of the investment, it was in the automotive sectors. However, we need to mention that Morocco, it's received the largest international project finance transactions announced in Africa during 2025, which is the $35 billion Sila Atlantic Cable projects, which is bringing together investors from Germany and United Kingdom. This far more than renewable energy project. Actually, it positions Morocco as a future bridge connections African renewable electricity with European markets. So it's also demonstrate how Africa is becoming part of the global energy transition strategies. So another fascinating development appears on this slide, which is not all forms of investment moved in the same direction. So we have the greenfield investment value declined. However, international project finance increased by around 24%. And what does this matter? So because the two types of investment often tell different stories, so greenfield investment usually reflects the companies established new productive facilities, while international project finance mainly supports large infrastructure, energy, and transport and industrial projects. So this is just suggests confidence in Africans' long-term growth remain intact. While also for the greenfield investment, it's already declined, but the number of projects has been increased, and which is basically, it reflects more broader engagement for investors in Africa. This slide explains where investment is going, in which sector. So the energy remains by far the dominant destination for international investment in Africa. So whether we examine greenfield investment, project finance, or the largest individual transactions, so energy consistently represents the largest share. Then it's followed by renewable energy, green hydrogen, electricity, transitions, oil and gas. All continue attracting substantial international capital. This reflects Africa's comparative advantage. The continent possesses exceptional renewable resources, including critical minerals and rapidly growing energy, which is critical minerals and for sure young labor forces and rapidly growing energy demand. However, but there is an important policy implication, so which is a success shouldn't be measured simply here by attracting energy projects. The real objective is to use those investments to build domestic industries and to develop local suppliers, create skilled jobs, and increase value addition. In other words, Africa should export more than electricity, oil, or minerals. It should increasingly export manufactured products, industrial capabilities, and technological know-how. This will bring me to the final message in this section, which is concerning to the changing geography of investment in Africa. So for many years, we have the Caribbean remains Africa's dominant investment partners. That remains true if we're gonna look for the FDI stock. However, if you're gonna look for the pipeline of the investment in the greenfield, so we can see that the landscape is becoming much more diverse. So ASEAN investors, they continue expanding. India, China, and especially countries from the Gulf. So we can see United Arab Emirates it's becoming the first country investing in Africa. So I will move to the third part of my presentation, which is related to the investment policy making. So here, the investment policy, we in 2025, the national investment policy making become more active and more selective. So the number of the measures reached a record high at 229, aimed heightened global uncertainty. So, and also we can see that the share and the number of the measures which introduced new restrictions or tightened regulatory conditions for foreign investors increased compared with recent years. So it is confirming that there is a gradual shift toward more cautious approach to investment openness. So, and here, if we're gonna focus on Africa, so over the past decade, African countries adopted approximately 315 investment policy measures. Around 80% were favorable to investors. In 2025, however, Africa recorded a significant increase in restrictive measures. So African countries adopted 30 measures in total, 19 favorable to investors and 11 restrictive. If we're going to speak about the investment incentives, so the investment incentives accounted for a record 50% of all measures favorable to investors in 2025. And this is globally, and also it's applied for the same trend is already applied for Africa. So the investment facilitations remained a key tool for attracting and retaining investment amid continued uncertainty. So, and for sure, for the investment restrictions, you can see that the number of the countries they already adopted the restrictions has really increased from 21 countries to 52 countries, and this is almost doubled. So if we're going to speak about the international investment agreements, so a total of 44 new international investment agreements were concluded in 2025, bringing the global international investment agreements universe to over 3,350 treaties, and returning to the annual number signatures to pre-2020 level. And also, nearly half of 2025 treaties were broad economic agreements, and the majority were signed between developed and developing countries. If we're gonna speak about the arbitration case, so the vast majority of the investor-state arbitration cases is almost 96% were based on old generation treaties concluded before 2010. In 2025, about 80% of the new cases were brought against developing countries, higher than the average share of previous year. And this is, if you're gonna speak about the regional, at the regional level, so Latin America and the Caribbean, they are more responsive region. So if we're gonna do the last part of my presentations, which is about the investment in strategic sectors. So we can see that investment in strategic sectors has expanded rapidly. It's already increased from 109 billions to 576 billions, which is basically five-fold. And if we're gonna speak about the share of the greenfield investment in 2020, it was only 16%, and then it's increased to 44%. So this expansion reflects distinct but interconnected investment waves. So AI infrastructure is the largest strategic investment sector, while semiconductor is the fastest growing one. Critical minerals, energy transition technologies, and other advanced technologies also recorded solid growth, with differences in scale, timing, and growth. So even if we're gonna see the concentration, it's highly concentrated. If we look for the top 3 investors in strategic sectors, they are 69%, while for other sectors 32%, and for the top 3 recipients as well for strategic sector, they are 50% compared to 26%. And if we look for the low income and lower middle income recipients, we can see that they are receiving much less in strategic investment in strategic sectors. And And then if we're going to move to the third stage, which is the manufacturing, we can see the manufacturing declines hitting the developing countries harder. And we can see that it's already, if we're going to compare between the two periods, 2015, 2019, and 2021, 2025, we can see that there's like a 17% decrease. And most of the decrease was on the least developed economies. Here it's for the industrial policy interventions. We can say that we can have data like we have like two different. We have promotional and defensive, and for the defensive, we can see that it's increased by almost 93%. And we can see that the essential security exceptions appear more and more in international investment agreements, especially in the period from 2021 to 2025, comparing to before 2001. So the industrial policy is increasingly driven by economic security. Here it's another interesting slide, which is related to the subsidies, which is subsidies provided by developing economies, which is we can see that there is subsidies are rising globally, but these charts illustrate differences in the capacity of the developed and developing economies to deploy industrial policy support. So although the number of the firm specific subsidies is broadly similar, but if we look for the financial amounts involved, it's differs substantially. So the value of these subsidies has risen sharply in developed economies while remaining relatively stable or declining in developing economies. For sure, we are not advising here developing economies to compete for strategic investment through subsidies alone, but they need rather than entering a costly subsidy raise with larger economies, they may achieve greater impact by using targeted, physically sustainable support. And here we reach the final slide of my presentations, which is basically the policy responses for developing countries. So we have 5 policies here. We are saying that the countries that should focus on a limited number of realistic opportunities where they already have or can build competitive advantage. And the second, which is the objectives, it's not to match the subsidy programs of larger economies, but to improve investment bottlenecks, supporting the identified priorities like skills, infrastructure, policy gaps, and so on. And the third one, which is manage national security risks without undermining openness. So targeted, transparent, and risk-based mechanisms can address genuine concerns better than broader sector restrictions. And the fourth one, which is in a context of the global uncertainty, countries should use investment promotion, facilitations, and aftercare to help preserve viable investment, address operational constraints, and position themselves to capture emerging supply chain opportunities. So finally, we use regional integrations as a development lever. Larger markers, stronger connectivity, and deeper regional productive networks can improve both the attractions of FDI and its contributions to development. And I'm going to conclude here and just give the floor to my colleague Judith and to also our distinguished panelists to discuss the report.
Thank you very much, Ashraf, for that presentation. I think your analysis clearly illustrates the opportunities and challenges for Africa, as well as the policy responses that are available to developing countries in an increasingly uncertain investment environment. Just for all our participants present here today, the presentation that has just been made, the report and the recording of this session will all be shared with you after the event. Now, I would like to transition into the panel discussion for our program today. All our speakers who have intervened, from Ms. Collins to Excellency Dr. Rostrom, and also Ashraf have set the stage with the key findings of the World Investment Report 2026. And we now move into a discussion around these findings and the implications for Africa. The objective of the discussion is to reflect on what the report's findings mean for Africa and to explore practical policy options for attracting investment that supports structural transformation, industrialization, and sustainable development. Excellency Dr. Rostrom mentioned in his speech that the key question now is how can Africa position itself successfully in a changing landscape. To help us try to respond to this, we're privileged to be joined by two experts whose experience spans government, investment promotion, and regional economic development. We have Mr. John Mwendwa, who is the Chief Executive Officer of Kenya Investment Authority. Mr. Mwendwa, you're welcome, and thank you for joining us this afternoon. And we also have Mr. Yunus Hussein, the Acting Deputy Director of Invest South Africa. Thank you, Mr. Hussein, for joining us. May I ask you to turn your camera on, if possible, Mr. Hussein, please? So I'll begin by inviting each of our panelists to respond to one question before opening the floor for questions and comments from the audience. And I'll start with Mr. Mwendwa. Mr. Mwendwa, the World Investment Report 2026 highlights that attracting investment is no longer sufficient. The priority is integrating domestic firms into global and regional value chains. Kenya has developed relatively strong ecosystems in agribusiness, ICT, and business services. What policies have been most successful in helping domestic firms connect with foreign investors and become part of regional and global value chains? Over to you, Mr. Mwendwa.
Yeah, thank you, Judith. I think first, just before I reflect on your question, it's always good to appreciate the context that this report has brought out. And I am not to start reiterating what has been presented, but what has come out clearly is that there has been a strategic shift because almost half of all announced projects globally, least developed countries attracted just barely 10% of that, and that really resonates to the African narrative, and that's why we are here. And I think the second theme I got from that was capital is no longer discussing costs as the key drivers of where it goes, but is also following a couple of points, including capability and a few other things that make the business case work, including scales, renewable energy, etc., etc. And Africa, as the report has been presented, while there was a dip, significantly everything else still went up, and it's very important for us because from where we are, and as I delve into your question, we must, as public sector, as investment promotion agencies, think very hard on what are we really trying to do to attract capital. And I think I will answer it maybe just in 2 or 3 parts. The first one is really addressing the cost of doing business. The report has cited, for example, what Kenya has done in terms of the fiscal environment, taxation, etc., being more agile in that, in our financial services sector, in the technology sector, etc. But while that is really good, the softer things, including the machinery that makes it work, for example, investor facilitation, becomes really very important. And I think Kenya has really been leading in that front. We have recorded, 100 plus reforms in the last 12 months or so, and we continue to do more. So we are really, really keen. And these are no reforms that are actually public sector driven. They are public sector implemented, but really resonate with what private sector is saying. The second is really also ensuring we really balance the risk-reward narrative. Investors are looking for a good return on investment, and while they take risk, they want just to ensure certain issues around risk are addressed. And I think we are continuing more and more to provide that. And if we were to look at our capital markets, we continue to go strong. Our securities exchange, for example, delivered, possibly the most progressive returns on dollar terms on the continent, 52% plus, last year. And we really want to ensure that the breadth and scope of what we offer in terms of the area of options is really sector agnostic. But where we stand a chance, for example, in our country, we are 93% renewable on energy, for example. So green industrialization continues to, be out of Kenya. The era of, AI-driven data centers, etc., technology, etc., etc. That is really important. And just as I pause there, my final point is really around how we see some of the big ticket items that we think are going to come. For example, Kenya has announced, ambition to grow our energy stock from 3 gigawatts today to 10 gigawatts in the next 7 odd years, thereabouts. So we think such kind of initiatives will continue to see foreign direct investment come into play. We have just launched recently, successively, a national infrastructure fund, a sovereign wealth fund. We think as capital becomes selective, Kenya really will become the answer. We're becoming more predictable, more stable. And we know really we can no longer compete on incentives alone. We have to compete on scale and capability. And I think that is really the narrative that we bring to bear. And we see the integration. You pivot out of Kenya, not for Kenya, but East Africa and to the continent and the global markets that we share. And that really connects to your point on the regional integration, the value chains you asked about. So we want to see whether really we can do regional value chains, because singular investments built on capability in one country, for example, may not really serve for the future, but we must really scale up on that and take advantage of that. So let me pause there and wait for my colleague to jump in as we get into the discussion.
Thank you very much, Mr. Mwendwa, for sort of giving us the context and identifying these three broad areas around which Kenya is organizing itself on the cost of doing business, balancing the risk and reward narrative, and then preparing for the big ticket issues. I'm sure we'll come back to some of this in the discussion. I'd now like to move to Mr. Hussein. Mr. Hussein, you're welcome. South Africa possesses one of Africa's most diversified industrial bases and continues to attract investment into manufacturing, renewable energy, and advanced industries. What lessons from South Africa's experience could help other African countries attract investment into higher value-added manufacturing rather than remaining primarily exporters of raw materials? Over to you, Mr. Hussein.
Good afternoon, and firstly, let me thank you, Program Director, and Ashraf and the team for putting out the report and having this launch today. I think I I note the contents of the report and the rich discussion today. I think from a South African perspective, industrialization does not happen by attracting investment alone. It happens by creating an ecosystem in which investment, infrastructure, skills, policy certainty, as my colleague said, with the policy certainty, the ease of doing business, and market access reinforce one another. This is perhaps the most important lesson for Africa. And this, in terms of my point of view, should rest on 5 key lessons. First, Africa stands at a defining moment where we need to move beyond resource extraction to value addition. Africa, as we all know, has abundant mineral and agricultural resources, but exporting raw commodities captures only a fraction of their value. South Africa has demonstrated that greater economic value is created when countries develop downstream industries such as automotive manufacturing, mineral beneficiation, agro-processing, the new industries like green hydrogen, battery manufacturing, and renewable energy components, for which we have master plans for each of these. The lesson is simple. Africa should export more finished products and fewer raw materials. This creates skills jobs, builds domestic supply chains, and increases export earnings. The second point is policy certainty attracts long-term capital. Investors in advanced manufacturing make decisions over 20 to 30 years. They therefore value consistency more than incentives alone. South Africa has learned that investment is encouraged through predictable industrial policy linked to infrastructure rollout, transparent regulatory frameworks, protection of property rights, efficient investment facilitation, and a public-private dialogue and support. Across Africa, governments should prioritize stable policy environments that give investors confidence to commit long-term capital. The third point I would add is building industrial ecosystems, not isolated factories. Successful manufacturing clusters rarely develop in isolation. South Africa's automotive industries illustrate how anchor investors attracts hundreds of component manufacturers, logistics providers, research institutions, technology transfer, and skills development partners. The lesson for Africa is to develop special economic zones, industrial parks, logistics corridors, supply development programs, and local SME participation. Rather than competing country by country, Africa should develop regional manufacturing ecosystems that integrate suppliers across borders. The fourth point, Madam Chair, is infrastructure today is certainly linked to industrial policy. Reliable electricity, cost and cheap electricity, transport networks, ports, rail, digital infrastructure, and water security are no longer supporting factors that are prerequisites for industrial investment. South Africa's experiences demonstrate that infrastructure investment directly influences manufacturing competitiveness, and thus, for many African countries, improving energy reliability, decarbonization, transport connectivity, port efficiency, customs modernization may deliver greater investment returns than tax incentives alone. The fifth point would be regional markets matter more than national markets. Many African economies are individually too small to attract large-scale manufacturing investment. The AFCFTA changes this by creating access to a market of over 1.4 billion people. Investors increasingly ask, can I manufacture in one African country and efficiently serve the continent? South Africa's experience shows that investment is strongest where firms can integrate into regional and global value chains rather than producing only for domestic demand. The next opportunity, which I think highlights in the report, is in green industrialization. The global transition to clean energy presents Africa with an opportunity to industrialize differently from previous generations. South Africa is positioning itself as a renewable energy manufacturing hub, green hydrogen hub, electric vehicle value chains, battery productions, critical minerals beneficiation. Other African countries can leverage their own comparative advantages where renewable energy resources, critical minerals, agricultural inputs, or strategic logistics to participate in these emerging industries instead of exporting raw materials alone. South Africa's experience again demonstrates that attracting a higher value added manufacturing requires far more than investment incentive. It requires policy certainty, modern infrastructure, skilled people, competitive industrial ecosystems, and access to regional markets, which the AFCFTA brings. The real opportunity for Africa is not to compete against one another for investment, but to build, to collaborate, to specialize, and to integrate regional value chains under the AFCFTA. By adding value to our own resources, Africa can move from being a supplier of raw materials to becoming a globally competitive manufacturing hub that creates jobs, builds resilience, and drives sustainable economic growth. Thank you, Madam Chair.
Thank you very much, Mr. Hussein. Thank you very much, Mr. Hussein, for your perspective. And I think it's really under the key message there is that industrialization happens by creating an ecosystem in which it can thrive. So again, thank you to our panelists for sharing their perspectives. I'd now like to open up the floor for questions and comments from our participants. I would like to invite you, if you would like to make an intervention, please raise your hand. And once you're given the opportunity, you may open your microphone and unmute, introduce yourself, and make your comment or your question, which could be addressed to any of the speakers, to our panelists, to our presenter, to our keynote speaker, if he is still connected, and also to Ms. Collins.
Judith, I can stay for 2 more minutes. I have a flight to catch, but if there is a burning question, I'm happy to take it before I wind up. Thanks.
Okay, let's see if there is any question that would specifically be addressed to His Excellency Minister Rostom. Isaac, is your question for the Minister?
Well,
Please
I
unmute.
don't. Yeah. Good morning or good afternoon from Ghana. My name is Isaac. I work at Ghana Investment Promotion Center. But then I don't know who my question could be addressed to, but I want to find out specifically from the presentation. I look at the stratification of Africa. I think the 2027 report has been released by the World Bank Atlas Map. I don't see the rich countries in Africa attracting investment. For instance, Seychelles is a high-income country. South Africa is an upper middle-income country. Libya is an upper middle-income country. What I see to be that the lower middle-income country and then the low-income countries are the one generating the FDI. Is there any metrics? What is really happening? Can we know why this is happening? Per the graph that she shared. Thank you.
Thank you, Isaac. Diary? Diary, please go ahead with your question.
Do you hear me?
Yes, we can hear you now. Please proceed.
Okay. Hello, everyone. My name is Tiarangiana Twanj from Economic Development Board of Madagascar. Thank you for this launch of the WARE for 2026. My question is about the data about Madagascar. In the FDI inflow, there is a big difference between the last year and the current year. So my question is, what is the cause of this change about the projection? Because it was decreased very much. So I want to ask the source of this decreases. Thank you.
Thank you very much, Diary. I think without holding His Excellency the Minister very much, let's just take this opportunity to thank you, Dr. Ahmed Rostom, for joining and for opening this session. I will give you an opportunity for some closing remarks if you wish to do so we can release you to catch your flight. Excellency Dr. Rostom, over to you. Okay, I don't think he's connected anymore. So let me take, I see, just see the participants here. Yes, we shall take Ojo Johnson, Amir, and T2 Huang. I apologize if I'm mispronouncing the names, and then we will hand over to our panelists. So Mr. Ojo Johnson.
Thank you very much for the wonderful presentation and the contribution from the other panelists. I want to quickly bring this question. It's a simple one, but I needed some insight in terms of what the role of political economy in attracting foreign investment, direct investment, especially to the identify sector that are key to the development of the national economy. I'm speaking from Lesotho in Southern Africa. In the past, what have been done, and some of the research as an academics, is to find the determinant of foreign direct investment and the flow, the direction of flow of foreign direct investment, which we know. But these days, according to what we heard from the presenter today, that's Mr. Abadelam, we see that main thing that should drive a foreign direct investment is not the issue of just competing to attract it, but actually to identify the priority sectors where this can flow into that can bring about the expected goal. Now, my question now is, now you have identified this, how do we align this or link this up with the policy maker, the decision maker in our different economy in order to achieve this goal that we are pursuing in the United Nations development, especially from this report? Thank you.
Thank you, Johnson. Amir?
Good afternoon, everyone. My name is Amir Fikri Abdeldaim, candidate of science, and I work in world economy and international development. So today, investment is clearly important for the transition to renewable energy. However, in my research, I argue that effective progress requires climate investment specifically. So how do you define climate investment, and what are the main factors needed to scale it in developing countries? Thank you.
Thank you, Amir. T2 Huang?
Very much. You pronounce my name very well. Thank you.
Your volume is very low. We can barely hear you. Could you move closer to your microphone, please?
Can you hear me now?
It's still a bit far off.
Hello?
Closer. Are you using earphones by any chance?
No, I'm using my laptop.
Okay.
Is this okay now? Is
That's better now.
better?
Please proceed. Please proceed, yes.
Thank you. Thank you so much for all the speakers and discussions for the very interesting presentations. My observations from your intervention is that industrial policy seems to play a role in promoting or attracting investment in targeted strategic sectors, as well as to build like the infrastructures. My question is, like many countries in the regions are members of the WTO and abide by some obligations nowadays under the trade-related investments measures or subsidies and other agreements. So in that context, what would be the policy space for Africa countries to excel industrial policy to attract investment? Thank you. That's my question.
Thank you. And finally, we shall take the final question from Sena Dake.
Thank you very much. And I'm Sena from the Young Chartered Accountants Network in Ghana. And my question is how our geopolitical tensions have actually affected the investments within Africa so far, and especially considering the impact it's had on our macroeconomic situations where there are lots of uncertainties. And yeah, that's the question, please. Yeah, thank you.
Okay, thank you very much. I think there are many questions that are related to the methodology and some of the findings of the report. So what I want to do is to invite Ashraf, and I think I'll also invite Nan to respond to some of the questions around why is it that it's low-income countries that are generating or attracting more FDI, the statistics on Madagascar, the role of political economy, how to define climate investment, the policy space for African countries to attract investment, and also how geopolitical tensions have affected investment in South Africa. There is also one question about in the chat. in monitoring global investment flows, what measures are taken to ensure that FDI inflows reported by countries reflect actual investment rather than investment commitments, which could otherwise inflate or distort reported figures. So Ashraf, let me start with you, and then I'll come to Nan, and then we'll close off with the panelists. So Ashraf, over to you.
Okay. So first of all, let's just start with the methodology, because a lot of people, they already asked about the methodology, and also I can see that in the chat box. So basically, we have there's explanatory note in the report which is explains basically the data that we used in our analysis. We have three types of the data that we used. We have the FDI. The FDI, and this is foreign direct investments coming from the balance of payments, and we are receiving this is directly from the central banks. And most of the data, they are verified. So it's all the member states, they verify all the data. So for the FDI data, this is we can say that by almost like 90 or 90%, those data, they are verified. And those are the actual FDI. This is the actual FDI. But if we're going to speak about the greenfield investment and IPF, International Project Finance, so the greenfield, it's from the FDI market, and this is a pipe. This is just give us like an indicators about the pipelines of the projects in the futures, and how this is going to impact the movement of the capitals in the future. So which is basically, this is only the announced projects, but this is not an actual FDI. And for the International Project Finance, it's more related to the infrastructure, which is basically investment in building roads, hospitals, like water treatments. So it's mainly related to infrastructure. So I hope this could cover the issue related to the data. You mentioned there is another questions related to the investment in lower income countries, which is basically most of the lower income countries, they are not attracting for sure a lot of FDI. They are attracting like a marginal percentage. But this year in the report, we mentioned that it says the LDCs already, especially in Africa, they succeed to attract FDI comparing to the previous years. So the previous years, the total amount of FDI was like $27 billion, but this year's $33 billion. So there is an increase. For sure, there's still room for improvement, and also attract more investment in LDCs. But again, it depends on each country and how the policy that they use to attract investment, and about the infrastructure. It's questions about infrastructures, economic situations, and the global uncertainty, trade uncertainty, and the geopolitical tensions. So there are a lot of factors that impacting the flows of FDIs to low and lower middle income. I can see that there was another questions related to the World Bank report, which is basically in the United Nations. We are following the classification of the United Nations, which is a developed and developing economies, while the World Bank is they are following different like groups like the high income, lower income, and middle income. So in our report already, we tried to use this classifications. This is just to have more in-depth analysis about the performance of the FDI within the different income groups by income levels. There was a question related to Madagascar. So I know that Madagascar's, I think they are getting a very low FDI. We are talking about in 2025, it's like $304 million comparing to last year's 231. Again, this is the actual number of FDI inflows, and this is what we have received from the authorities in Madagascar. So and basically most of the information that we received, it's related to the actual flows of FDI. we don't have the authority to ask about the details, what is about the numbers, which is basically this FDI in which sector, or the amount allocated for certain projects or whatever. So this is a more confidential data. It's what we are getting. It's just like the headline numbers. Another question I think there was about the strategic sectors, and I will stop here. So which is basically we have actually we had a lot of discussions when we prepared the report, which is about the strategic how we call the strategic sectors, because the strategic sectors, it's a strategic from different perspective. From each country, each region, they do have their own strategic sectors, and here what we are calling it's the most strategic sectors or key strategic sectors that they are attracting more investment globally. But we are not saying that this is should be the strategic sectors for each country. We don't advise that. So each country, they do have their own national plans of development, and they do have their strategic sectors and strategic priorities. So what developing countries needs is in order to achieve the SDGs or to increase the investment more, to get more investment, it's just to follow their national plans, which is already determined their strategic sectors. We are not advising like developing countries to go and compete with developed countries when it comes to key strategic sectors, like providing subsidies and all this, because we know that a lot of those countries, they don't have the physical space to do that. But at least they can be more reasonable when it comes to having the policy to facilitate investment, and also related to the aftercare services and so on. So I will stop here.
Thank you very much, Ashraf. Nan, over to you.
Sure, thanks. I will add a few perspectives on the political economy and impact, right? So I think a few colleagues asked for that. It is really becoming a important consideration, right? So in addition to the consideration of cost, efficiency, market access, when more investors are being affected by the political economy and all these geopolitical changes and disruptions. So one obvious factor is uncertainty, right? So this type of uncertainty really affect and delay many decision making. For example, trade barriers, right? Trade tariff change, where you can see actually in the report, there's part of the discussion, chapter 3. So if you have time to go through chapter 3, where we are analyzing the sectors, exposures to trade policy change, right? Investment, how it's being affected by trade policies. Of course, another one is the strategic rivalry, right? So you've seen the strategic rivalries between major powers, and then the selection and choices of technology solutions, critical mineral, all these become very sensitive areas for global debates and investment policies. Another key issue is the supply chain resilience, right? So since COVID, this disruption of global supply chain, the consideration of resilience, for example, the China Plus One strategy, or this more diversification resilience strategy really also changed some decision making. Of course, some countries are benefiting from it. For example, we see increased investment flowing into, for example, Morocco, right, on this continent, due to its also strategic location and the investment framework with EU, US, China. So in a way, a few concrete strategy and solutions countries we're observing that countries are adopting, right? So on how to deal with those risks while harnessing those opportunities is to look into investment framework partnerships with all sides, and really look into your own competitive advantage, right? Where I think in our launching at the Geneva, the Morocco ambassadors will share their experience to build on renewable energy supply chain and also grow that sector. So I think it's really for countries to look into your endowment, your competitive sectors, and be selective in using industrial policies. Obviously, industrial policy is affecting many countries. Africa, many countries, we don't have the physical space to compete subsidy for subsidy. So this is where we need to prioritize, target, and build your competitive advantage, and also look into the regional integration opportunities as the aggregator platform, right? So these policy recommendations are also in the report. Again, chapter 3 has a dedicated policy response sections, both for national level and international level, right? So from political perspective, internationally, while the space for cooperation is being challenged and narrowing, how do we still keep a set of investment commons? We are also promoting the idea of preserving this space for international cooperation investment. And we want to use the World Investment Forum as a platform to further debate those policy issues and promote partnership building for developing countries. Let me stop here. I think there are more specific country-based questions or sector-based questions we can follow up after the call. Please feel free to get in touch with us, Ashraf, who's watching Africa investment, and myself. We're happy to answer more questions. Please read the report.
Thank you. Thank you, Nan, for those reflections. And thank you, everybody who has shared their perspectives and asked questions. I would like to hand over to our panelists just for their final reflections. But before I do so, we might be caught up on time. So I would like to beg your indulgence for about 10 more minutes to give us an opportunity for final reflections from our panelists, and then to close up the event as well. So thank you for those extra 10 minutes. So I'd like to move to Mr. Mwendwa and Mr. Yunus just to give us some final reflections, and also in that, if you could specifically address the question of how geopolitical tensions have affected investment in Kenya and South Africa specifically. So we'll start with Mr. Mwendwa. Over to you.
Yeah, really exciting to hear the reflections from colleagues across different parts of the world. And I think for us, if I may just then default to Kenya, I think the geopolitical economy is not unique to any particular person in the world today. We are all interconnected. Something happens in the Far East or in the Middle East, it affects the global economy. So I think for us to be future-proof is really ensure we, as a country, as my colleague from South Africa also spoke about, the industrial policy and the trade policies that countries continue to put at play must really resonate with how we can really do a good investment play for critical sectors. And I don't think each country will have an infinite array of opportunity. There will be select few where they can compete and at scale, because we'll never have a risk-free, macroeconomic environment globally. There is not particular one that risk-free, but investors know how to follow the money, and they follow the money where, the portfolio of issues they look at. When it's all compounded together, it makes really good sense. So I think we will continue in Kenya. We have very ambitious plans in terms of growing our FDI numbers in the next couple of years to not only the $3.2 billion that was in the 2025 report. We want to get to $10 billion fairly quickly. And to do that, there are a number of areas we are looking at, our economic zones that are continue to become, very progressive. But also, we have the best talent. We pride ourselves in having the best talent and skill set, as my colleague from South Africa said. Skills play a good role in where you are playing in terms of placing your investment. So we continue to do that. And then finally, really, the investment ecosystem, the business environment will continue to be possibly the most consequential aspect as we all compete for capital. And because Africa is the future of growth and the next frontier, I am sure most of our countries on the continent will continue to do this, even as advanced economies still continue to give us a run for capital. But we think this tide is likely to change for the better in the very short term, if not medium term. I thank you.
Thank you very much, Mr. Mwendwa. Mr. Hussein, over to you. Same question, some closing reflections, and how the geopolitical tensions have affected investment in South Africa.
Look, I think from a broad perspective, I think my colleague has articulated it. But I think today the political economy equals the actual economics of the global world. So the thing is, in broad, I would think that countries today, particularly on the African continent, we need to set the value or our place in the global agenda. And when a country by country place in terms of what would be their investment in terms of moving up the value chain or value addition. And in thereby doing that, you would build much more resilient supply chains. I think that's for long-term sustainability. I think that's what African economies need to do, is to build value chains, ecosystems, linking to supply chains, so that we are not vulnerable. I do think that besides industrial policy, today's dynamics call for very coherent, from a country perspective, to link trade policy with industrial policy, and that goes hand in hand. And what also goes hand in hand is also investment policy. So industrial policy, trade policy, and investment policy. Your investment policy would deal with your aspects of investment climate and making your environment or your ease of doing business easier, as well as will deal with your investment protection, issues of investment agreements, property rights, and legal jurisdiction. So these three if countries have a very clear policy on investment, on trade policy, linking to industrial policy, that builds and transform Africa from extractive industries to more higher added value. Because I don't think on the continent we want to miss this opportunity, having all these resources, whether it's minerals, whether it's agro, or so forth. I think that Africa should define its value in the value chain, and make concerted efforts amongst member states that can cooperate and collaborate with each other, to ensure that the continent benefits with all its natural resources that it's been blessed with. Thank you.
Thank you very much, Mr. Hussein, for your final remarks, and also to you, Mr. Mwendwa. And thank you once again to all participants for their interventions and comments. I note that there is also a discussion that is happening on the chat, and we will find time to respond to some of this. And I also see there's a question specifically on the STO. Wow, and I see Mr. Loha has provided contact details, and that conversation can also continue after this. So thank you very much once again to all our speakers and participants for a rich and insightful discussion. I think today's discussion has reinforced several important messages coming out of the report, and also from experiences of countries. Number one, while international investment is recovering, the uncertainty still remains high. Secondly, Africa continues continues to attract investment into strategic sectors, but there is significant work still to be done to ensure that these investments generate wider economic transformation. Third, the quality of investment matters just as much as the quantity, especially for investments that strengthen productive capacity, create employment, support technology transfer, and accelerate sustainable development. And as we've also heard from our speakers and other participants, it will be important to link trade policy with investment policy and industrial policy. It is important to build value chain ecosystems linking to global value chains so that Africa is no longer vulnerable to geopolitical tensions. It's important also to organize and prepare a business environment. And all these priorities resonate strongly with the implementation of the Geneva Consensus that was adopted at the 16th UNCTAD Triennial Conference, which reaffirms the importance of investment as a driver of inclusive and sustainable development. So thank you once again. This brings us to the end of the panel session. I thank you all. And just before I hand over to Ms. Nan Collins for our final remarks, I would like to request all of you to please turn on your cameras for a family photo, and you can leave your cameras open for the duration of the closing segment. And I would also like to thank our keynote speaker, His Excellency Dr. Ahmed Rostom, for joining us, Ms. Nanli Collins, and Mr. Ashraf Abdelal for the work that went into preparing the report. Our distinguished panelists, Mr. John Mwendwa and Mr. Yunus Hussein, thank you very much for your interventions. Our participants from the governments, from regional organizations, academia, private sector, development partners. Also, thank you to the UNCTAD teams in Geneva and the regional office in Africa for organizing today's event. The World Investment Report 2026, together with its regional findings on Africa, is available on the UNCTAD website. As I mentioned earlier, we will share this with you together with the presentation and the recording. And we encourage everyone to continue this important dialogue and use the report as a resource for evidence-based policymaking. And now, finally, I would like to invite Ms. Nan Collins to officially close the event. And Nan, over to you.
Judith, I think you already summarized very well. So let's just take the photo. And if you have any questions, do get in touch with our team and do download the report on our website. Thank you. Let's take the photo.
Thank you very much. Please keep your videos open for just about a minute so we can capture as many photos as possible. Thank you very much, everybody. Thank you very much, Excellencies, distinguished participants, colleagues, ladies and gentlemen, and we wish you a very nice rest of the day. Thank you.
Bye.
Bye-bye.
Thank you.